The legal system is just really inefficient at creating desirable outcomes.
All right. Hi, everyone, and welcome to Housing Insiders, the podcast for founders, builders, lenders, and regulators, and anyone who believes that everyone should be well housed. I am Jonathan Lawless.
And I am Jeremy Potter. On Housing Insiders, we're hosting the conversations you won't hear anywhere else about how to make housing more innovative and attainable.
We're super excited to partner with the law firm Saul Ewing. We'll talk about more in a second to bring you these smart conversations. But if you have another idea for a guest or a show or have an interest in sponsoring an episode, please email us at podcast@thehousinginsiders.com.
And if you like the show, please give us a review, spread the word, share the show so we can get the podcast out there and make more of these episodes for you.
Awesome. All right. So like I said, Saul Ewing is the sponsor of today's episode. They've been a great friend and partner of Housing Insiders, helping us make this show possible. So super happy for having them join us. I'm just going to simply ask our two guests today to introduce themselves and tell me a little bit about Saul Ewing. So Tripp, why don't we start with you? Introduce yourself, maybe give us a little bit background on Saul Ewing, and then we'll turn it over to Jason.
Thanks, Jonathan. And again, thank you, Jonathan. Thank you, Jeremy, for having Jason and I on this podcast. It's really exciting, and we look forward to its success. So I'm Tripp Riley. I'm the chair of the Saul Ewing's Consumer Financial Services Practice Group. This group's focus is on consumer financial services. But for the purposes of our audience today, we have a specialty in mortgage. So that's mortgage origination and mortgage servicing. We provide regulatory counseling relative to compliance. We provide litigation defense primarily, where mortgage originators and servicers are sued by individuals or class action, as well as defending the same companies when you have a government investigation and enforcement. And lastly, because we all want to be compliant, we'll provide compliance auditing when your company may be about to be visited by either state regulators or federal regulators. So that's a little bit about the group. And for myself, I practice in that area. Primarily right now, I'm dealing with a great deal of government enforcement actions and investigations, and providing clients with counseling with respect to that.
Awesome. Thanks, Tripp. And Jason?
Yeah, so Jason McElroy, I am the managing partner of the Washington, D.C. office at Saul Ewing. I've been practicing for 20 years now, which is a wild thing to say because I don't feel like I'm that old. I do, government investigations, enforcement actions, consumer class actions, trade secret type of work, all in the consumer protection space, doing a lot of work in consumer finance with a pretty heavy focus in mortgage for the last, 15, 16 years. I've been doing this. Primarily do litigation, but I do a decent amount of regulatory counseling as well. Things like when the CFPB started, for instance, I did roughly about 45 what we called mock exams, helped stand up a program for what we call the mock exam, went around and helped non-depository lenders, primarily mortgage lenders, get ready for federal supervision, which they'd never really had before. So that's just sort of a 30,000 foot view into my practice.
And just because I'm the only non-lawyer on the call, if I'm starting a mortgage brokerage, which I'm thinking about, and I have questions about how to comply with RESPA or any of the number of things that sort of regulate the mortgage industry, you guys would provide advice, or if there's litigation that comes against the company relative to one of those things, I should turn to you. That's how to think about it?
Yeah, I think that's the way to think about it. But I also think that whether it's a starting of a new company like a mortgage brokerage or lender, or a product or service. So existing companies who are entering the market or want to enter into the market with a particular product or service, then they'll come to us and say, look, given your regulatory background, your compliance background and experience, as well as, and sometimes most importantly, your litigation, your risk analysis on the litigation side, what issues, if any, do you see with this product or service, and how can we tweak it if necessary so that we're not in a few years or a few months facing either civil litigation or government investigation.
Tripp and Jason, thanks for being here, because I think you just laid out exactly what is relevant as we think about the housing continuum and specifically housing finance. When I was in-house counsel, John mentioned my legal background. One of the first things my new leader told me when I joined Quicken Loans was the only constant here is change. And I think that's been true of the regulatory and enforcement landscape in mortgage, in housing, in title. You have to deal with that in the trenches with your clients, and it's constantly shifting. And so, when I was thinking about where to start the conversation here, this is a perfect segue into my question, which was, where are we right now? Because I always think of litigation as the resolution of decisions that were made by the company years before, right? So I made some decision years ago. It's coming now to the forefront and landing in your firm. But then also, you have one foot with clients who are making decisions right now that won't be resolved for several years. So can you kind of walk us through, Trip? We'll start with you. Can you kind of walk us through, what are you seeing right now? What's the lay of the land right now that you're seeing from those decisions that were made years ago? So what are we litigating right now in this industry?
I think that the decisions made years ago, or maybe not years and years ago, but years ago, that we're now seeing litigated. And I let me just back up and give some context, because we're not really seeing investigations and then resulting litigations at the federal level. We're really seeing them at the state level, at least currently. If we look back, maybe at the beginning of the new administration to now, maybe a little further back, you're really seeing the states trying to find the right cases, the right issues to bring litigation about, so that it's not a shotgun approach. Like, I think a lot of people thought with the new administration that this would be, states in particular, states that have Democrats as in the governor's or in the AG's office, that it would be a shotgun approach. They would just say, boom, everything the CFPB was doing before and not doing now, everything the DOJ was doing before but not now, everything that the FTC was doing, so forth and so on. We're just going to, basically vomit up as much litigation as possible, to basically on the reverse side own the conservatives. So, like, we're going to show you, but that's not really what's happening. And so what I'm seeing again is a very precisioned approach to what issues states are taking. And you can look at Pennsylvania, where the AG even though it's a brand new AG, a Republican AG, he has decided that he's going to allow a case that was filed at the end of the year, which was a RESPA case, on novel theories of what is a thing of value around affiliated businesses. And so again, it's a very precise attack on affiliated businesses, but not that they're illegal per se, but rather the way in which they're formed may cause them to be illegal. And so again, very precise. Other than that, I think you also see states taking a precise attack on sharing of consumer information, and I guess to some extent, like lead generation. What is being told to the consumer within that ecosystem about what happens when you give up your information and allow us to use it. So I think that we see that there. But I do think decisions around fair lending and fair housing those decisions made during the last 9-10 months are gonna rise to the surface for the states.
And if I can pick up quickly on the lead gen point here, we're seeing record numbers of TCPA cases being filed now as well. And this is something that, as of 5 years ago, after the Supreme Court ruled in the Facebook v. Dugweed case on the definition of an ATDS, an automated telephone dialing system, we saw them really go downhill. Now we're starting to see them come back a lot. And I think that you're talking about decisions that were made years ago, decisions that were made on lead generation providers, on how you're going to follow up on those lead gen leads that you got, how you're going to get your consent. That's coming back and rearing its head in a lot of these cases as, you know, the plaintiff's bar has really cycled its way through and back into this area.
And the one other thing, the one which is surprising, not surprising, is the one thing Congress has been doing and has done is the trigger lead. We see a bill that was just passed, I believe, in the House constraining trigger leads. While it's surprising given sort of the movement or lack thereof of Congress with the new administration, and certainly it'll be interesting to see, you know, who's going to have authority. Oh, if that bill becomes law, who's going to have authority over that? Whether it's the CFPB or it's the FTC, you know, and what regulations are needed, or you know, or will come along, or guidance will come along on that. So if you're looking back at what you've been doing to get leads, and then how you're reacting to those leads, you better pay a lot of attention to that bill.
Yeah, I think that's a great example. I mean, one of the things that we hear a lot about in especially the mortgage industry related to both lead gen and TCPA in particular is sort of like the regulator's ability to look backwards and change the understanding or interpretation of something once time has passed and they're reviewing practices or decisions that were made. One of the questions I had on that in particular was around the trigger leads. I understand how threatening they are to more traditional mortgage companies, but I also was surprised how much money goes into this. I guess I'll put it bluntly, it must work, right? Like these trigger leads work. Otherwise, there wouldn't be so much activity and so much money behind it. When you encounter a question like that, how should clients be thinking about it in the sense that like legislation could change? That's a pretty long view. You have the threat of a regulator kind of reinterpreting stuff just because climate changes. And I got to make a decision today. Is trigger leads and lead gen the right example to use? And if it's not, use a different one. But how do you make decisions, and how do you advise a company to make decisions when you have all these moving parts and you don't actually know what the future holds?
And I would add, how do you advise someone in-house, whether it's an in-house lawyer or a compliance person, about something like that? Like, what should we be doing in this fluid area when my business people are saying, wait a minute, we can make a lot of money either on profiting from the trigger leads, however that profit may come in, and you know, what should we be doing? I think that because there's a potential federal statute, the trigger lead thing, I think states will follow that as long as it's robust enough. So I'd pay attention to that. My concern on that, what do you do when your business person comes to you today and says, look at the regulatory environment today, the compliance environment today, what should we be concerned about? And what I think we're concerned about is if the federal government is either stepping back from their role, they are making decisions to potentially rescind certain regulations, or without any changes, just complete rescission. The concern is, okay, what about the states? The states are going to look at that and say, we're going to try to fill the void. And so I think the first thing you need to do is if you're a national lender, a national servicer, a national broker, where is most of your money coming from? What states? And start to focus on those states. Like, what can we expect that, for example, in LO Comp, if they rescind that that regulation completely, which is, it's unclear what the administration is thinking about, or the CFPB is thinking about, whether it's a full rescission or a rescission with a new rule or a partial rescission. You know, is it we're going to own the libs and completely rescind it and then just sort of say, it was terrible, get away from it, let's get rid of that. If they do that, then you have to fall back on Dodd-Frank. And Dodd-Frank is a very draconian prohibitions with respect to LO Comp and so forth. So what do you do? How are states where you're doing the most business going to react to that? Are they going to be like, okay, well, we'll just follow Dodd-Frank We have authority under that. We can make arguments about violating of Dodd-Frank is a violation of our state consumer protection laws. And that's where I would focus. I would focus on what's the worst case scenario.
So Jason, we want to talk specifically about LO comp for sure and the CFPB rollbacks. But just on this advice question I had for you, do I, as an in-house counsel to a lender, have to be proactive, or how proactive, how nervous do I have to be that something's about to change, right? Because that was always my concern. My concern as an in-house counsel was I should be allowed to follow the trigger lead rules, follow the LO comp rules as they are today. But if I am pretty certain they're changing tomorrow, I'm going to be judged for that, aren't I? Even though I have the cover today. And I know it's an impossible answer to some degree. It's always a calibration. But specifically on these two, what am I supposed to do?
I think the best route, for me as a counselor is to say, look, this is what the law is. It can always change, right? It can change tomorrow. We can prepare for what we think it might change to. We can prepare how we might change our business practices. At the end of the day, we're running a business. The business has to bring revenue in. In order for me to serve, or you to serve your purpose as the best counselor to the business, we have to balance that fact that the business has to run and it has to run compliantly. So, knowing what it is today and knowing what we can do and how we can work within the framework of what it is today, I think that's what you have to do until you know that it's going to change, or you know what it's going to change to. Right now, particularly with this administration, we don't know what's coming next. We don't know if the rescission is actually going to occur. We know that it's been requested, but if it occurs, we don't necessarily know whether they're going to replace it with something else. Or, is the idea for LO comp particularly, is the idea that, we're going to rescind and replace at the same time. That would be probably the best case scenario. But can we trust generally the government to do that? Probably not. I mean, it took them how many years to implement the 1033 rules, let alone the original mortgage servicing rules. The idea that these things are going to be rescinded and immediately replaced is a hard one to get behind. The trigger leads, I mean, I think that makes an even more business forward case for it, because right now you can use them as long as you're following, general TCPA requirements, to the extent that TSR might apply. Probably not as much, the telemarketing sales rule in this situation. But as long as you're, following the standard rules that apply today, I think that from a business perspective, it's probably putting you at a disadvantage not to be using them.
I want to get into some of the specific issues because, I mean, from a business perspective, the number one thing I want is clear regulations that let me do whatever I want. The second thing I'd like is clear regulations that allow me to do what I need to do. But the last thing I want is ambiguous, constantly subject to interpretation rules that are changing all the time. Unless my business is Saul Ewing litigation and advice service, which it must be a real benefit, because I just can't imagine making a decision on any of these types of areas without relying on significant counsel and maybe even proactive work at the state level. So I want to get into, sorry, Trip, to cut you off, but I wanted to start thinking about the Republicans really came in with this idea of trying to get to state one, which is the clear, very low regulatory environment that allows businesses to not be constrained by by needless regulation. Let's say would be their, I think, the way they would say that. But by doing so, they've removed the regulator. Now there's a lot of things in flux. So those things in flux are these rescissions, particularly at the CFPB. I want to learn a little bit more about the LO comp issue. So let's start there. But I'd be curious to get your thoughts about what are the major things that have now entered into a more ambiguous realm that every person in the mortgage industry needs to be thinking about. And hopefully later we can what do we do about this? But in any case, can we start with LO comp? Give me the sense of the history, the background, and what the rescission specifically says and what the implications are for people in the industry.
The LO comp rule came out of Dodd-Frank, as Tripp mentioned. The Federal Reserve actually issued an LO comp rule under Regulation Z under TILA first, shortly after Dodd-Frank, maybe a year or so. I think it was early 2011. I don't have the exact date in front of me. But they issued it before the CFPB was even set up. right? The CFPB wasn't set up until mid-July 2011. That's when the CFPB came online. Dodd-Frank Act was passed in late 2009. You had this time period where the statute existed and where there were requirements that the CFPB was going to have to do this. The Federal Reserve kind of stepped in and filled that hole initially, and then the CFPB later superseded that and filled it by their statutory requirements. And it all came out of the thought, at least the general majority thought, that loan officers were being incentivized improperly in the lead up to the 2008 recession. So the idea was really that the more the loan officers were incentivized to put people into loans they couldn't afford, for instance, by receiving higher compensation based upon the amount of the interest rate. So the higher the interest rate, the more expensive the loan or the more profitable the loan for the company, when they sell it on the secondary market, the LO receives more compensation there. That incentivized the LOs to push borrowers into those products. Now, I don't know that it's really clear from that we have real clear data that was firmly happening across the board. But I think anecdotally, there were clearly situations where it was happening and Congress jumped on that. And that's generally the thought as to why there were some requirements, regulations needed to regulate the way that loan officers are compensated. So the LO comp rule now, as I'm sure most people listening to this podcast know, generally precludes lenders from paying loan officers on the terms of a loan or a proxy for the term of a loan. So generally you can consider this to be things, like the interest rate's obvious one. The way that most organizations go about dealing with LO comp now is they pay on the volume of the loan. That is the dollar volume, the dollar amount of the loan. And that's clearly okay under the CFPB rule. So you get 100 basis points on a $200,000 loan is the commission for the LO, for instance. So that's where we sit today. And that's just sort of a basic assessment of it. And rescinding that, as Trip said, would probably push us back to just the Dodd-Frank rules. Some people have questioned whether or not it would push us back to the Federal Reserve rule. I'm not sure that would be the case. I think that you would just fall back to default to what the Dodd-Frank statutory provisions state. That is, if the CFPB doesn't have some sort of rescind and replace plan in for it, which it does not appear that they have now. Right now, they've requested a rescission plan effectively from OMB.
I understand the motivation. I think Bob Walters in our last podcast sort of said, tell me the incentives and I'll tell you the outcome, right? So you don't want just having a structure that incentivizes people to do the wrong thing is not good. Okay, so make LO comp should just be like a flat percentage, easy enough. That everybody should just do that. But what it's sounding like you're saying is like there's some confusion. Like what are the situations now that like who's doing LO comp differently than that is now like, oh, I'm confused as to whether or not I can, like, isn't this a pretty clear cut and dry, like just don't do incentives for certain type of loan products?
You have a lot of interesting interpretations of what this means, Jonathan, and I don't mean that in sort of a derogatory fashion necessarily. But I've dealt with in the mid 2010s. I dealt with a couple different CFPB enforcement actions and investigations dealing specifically with LO comp, and one of them was this sort of setting up of it's LLCs, right? So the LOs would set up LLCs, they would pay through the LLC, and then the LLC would be able to pay them. And effectively what the CFPB said was that this was a way for them to be paid on the profit of the loan. And, looking at the data, you could see how they came that way. You could also see an argument under the law why this particular mechanism would be appropriate under the law. But sort of the way that it's set up now, I don't want to say incentivizes again, but it kind of incentivizes people to be a little bit clever with the way they're trying to comply with it. So think back to the times when people were trying to do point banks, and using point banks is something the CFPB came out and clearly ended up saying this is clearly in violation of the LO comp rules. But for a while, people were trying to set up point banks and basically saying, all right, well, you can stack points in here based upon certain attributes of the loan. And every now and then you still kind of hear this. I'll have a client call me and say, I've got LOs who are telling me that Bob's discount mortgage down the street is using a point bank, right? And can we use a point bank? So you still kind of get this question every now and then. And it's not necessarily a point bank. There's some other, sort of clever mechanism. Sometimes they're not even that clever, right? Sometimes they're just saying, we think we're small enough, we'll go under the radar, and we think we can poach enough business. We're just going to straight up pay our LO as part of the profit. That is clearly 100% in violation of the current LO comp rule and would be in violation of the statutory provision as well.
Just a pulse from your clients or a pulse from the industry. Do lenders want LO comp to be rescinded? Was it a problem for them? Because sometimes I'm thinking of how, sports leagues like the NBA or the NFL, the association is there to protect the owners from themselves so that they don't, that there are actually rules because they know that these 32 owners are going to make bad decisions themselves. And so they put these rules kind of would you say that your clients are like, yeah, actually we've been asking for this to be rescinded, it needs to be, or is there a pulse that you're getting from your clients today?
I haven't heard anyone say we want LO comp rule to be rescinded. I think that mostly what people want is they want changes on the margins to, various aspects that may be detrimental or they may see as being detrimental to employee retention.
And I also think they want a bit more clarity. It's not as simple as Jonathan, I guess, somewhat suggests, is that, it's all it is about percentage or basis points based on what. There's a lot of other different loans require different compensation, different types of, brokerage versus creditors. What's the creditor paying the broker? Those type of things, those sort of nuances, they seem nuanced to the general public, but they're not nuanced for someone who's actually running a brokerage or a creditor. And I think I would agree with Jason. No, I don't think anyone wants a full rescission, which would take us back to Dodd-Frank. They want a reform, right? And there are a lot of the industry, MBA has done it. Colleagues of mine, I'll just throw out Brian Levy. He's a leading commentator on LO comp and the problems with LO comp. It's out there about what that is. And that leads, if you don't mind going into another subject, that leads into like RESPA, right? So RESPA, the NBA and some other associations are looking for reform. And remember, RESPA is not just about prohibiting kickbacks. RESPA also applies to servicing of the loans. And there's some issues there as to, what is it on servicing? What, the requirements of responding to a QWR. How do we know it's a QWR? Can we really just say we don't think it's a QWR and then tell them it's not a QWR? But we still are responding. So what is it that we need to? There's a lot of, again, nuances to that. And, reform at Congress. I mean, again, I'm surprised about the trigger leads, what's going on there. I really like to know what's really actually driving that, because if you look at all the other industry commentary on and requests for revisions or reform, they're going nowhere. I mean, NBA submitted its proposal or its talking points on RESPA reform a couple months ago, and I haven't heard that, there's a bunch of senators or congressmen are like, yeah, let's do it. Your question was like, where else are we seeing? What are Jonathan's like, what else? LO comp, what else? Well, I think it's sort of in my practice, which does have a good deal of focus on RESPA compliance, are these things that are happening that may be okay in some instances, but trigger the potential exposure to RESPA violations or alleged violations on the referral provisions of that statute. For example, dual compensation. I mean, there are so many people out, once dual compensation, that rule was amended by FHA, all of a sudden everyone's jumping in. I can be a real estate agent and a LO and a title agent all the time. I'm licensed, but I don't have to do anything. I don't see any federal, response to that. So what you're going to see is states saying, okay, I see that, but my interpretation of RESPA is, that's either a violation or doing that is just simply a violation of unfair, deceptive, abusive practices. And they'll tell you why they think it's that way. And they'll get you retroactively. It's always been, you go back 3 years, and I'll just, as an example, use the RESPA case that Jason and I are involved in Pennsylvania, where the state AG has said the definition of a thing of value includes the investment itself in the affiliated business. Never in my 32 years of practice and my focus on RESPA has that ever been a consideration. And even if the state is right that could be a consideration, they're going to try to tag people retroactively, go back 3 years and say, well, you have a problem with your affiliated businesses for the last 3 years. The problem that I see, that the genesis of that is typically states will follow the federal government, whether it's states following in fair lending, the DOJ, RESPA, they follow. They may have their own idea, but they'll go to the federal agencies and say, look, this is my idea. What do you think? Again, my experience is if the CFPB said, no way, for a variety of reasons, I don't either agree with you or it's disruptive, to our guidance or what have you. You're not, we don't want you to do it. Most states will not do it. Okay. I mean, there might be some outliers. There might be California in there. There might be New York, some outliers there where they'll say, okay, well, thanks for listening to us. We're going to go ahead and do it anyway. But most states won't, right? Because they're following the lead of the federal agency who's supposed to be, the enforcer, the interpreter of those statutes and those rules. Now, again, you can go back to LO Comp. What happens if there's a revision and we have states interpreting Dodd-Frank?
Yeah, one of the things that's fundamental to this trip that it was always interesting to me and remains a challenge, I think, for both in-house counsel and just the industry generally is when you make a decision under today's rules, and I want to use either the dual compensation is a pretty good example, but I think business models, fair market value are also examples of this, which is if you have the data to be able to show, here's why I did it, and here's what the deal was that the consumer got. Like if your response to UDAP or your response to a regulator is like, hold on a second, let me show you a comparison to where our deal or our practices result in a better situation, a better experience, a better cost for the consumer, I should be okay. It's very logical, it's a very rational response. The problem in our industry is it's so difficult to prove that with the way that rates work, with the way that disclosures work, with the opaqueness to some degree of how pricing works, to actually be able to put things side by side and say to the regulator, I am confident I really did get the best deal for my customer. And putting these three roles into one role, yes, results in more compensation to this one individual, but it resulted in ultimately less cost than paying all three of those roles separately. I think UWM is struggling with this in Ohio. And I don't know the intricate details of that case, but trying to say it was a better deal or it wasn't a better deal. It was the best deal or it wasn't the best deal for a client on any one deal is so virtually impossible with the way disclosures and pricing work that you kind of can't rely on that, even though you may be making what is a really good faith effort to give them the best experience, to give them the best deal. And I think we will continue to struggle with that for a long time, kind of no matter what happens with some of these rescissions.
Yeah, and I think that some of this too, so some of what you're talking about, Jeremy, comes out of this concept that there always is a data-driven or an empirically provable best deal, which I just really don't think is the case, because at the end of the day, the consumer knows what's best for the consumer. And while there are some sharp practices that, have occurred in the past, will occur in the future, always have, always will, at the end of the day, the vast majority of loan officers and lenders out there are just trying to help the consumers, trying to get them into a product that works for them. And the consumer knows that's what their personal situation is the best, right? And so at the end of the day, having to come in and kind of prove empirically this sort of impossible scenario is a situation that legally just shouldn't exist, but politically, and this is where we always end up, right? Politically is advantageous to people who want to push certain political agendas.
Yeah, and to dovetail off of that, and we can use some specific examples. And I'll first say that, Jeremy, using or wanting to use the argument that I put them into maybe not the best deal, but the best deal that exists, the best deal for them within, certain margins. Unfortunately, if you try to make that argument up front, no one's listening. No regulator, no enforcement agency is listening to that. And ultimately, you may get that at the end of the day. But if but you're fighting against, no, but there was a violation. It doesn't matter, right? So let's give an example. Let's look at the Townstone matter. Okay. Townstone out of Chicago, broker or lender is, alleged to have, through his exercise of free speech on a radio show, discriminated against prospective borrowers by discouraging them to apply to him through via his statements. Okay. And so, but all of the empirical data was that had no impact on anybody. They were able to explain the HMDA based upon the market. They were able to show to the Bureau that no prospective consumer saw that as either discriminatory, racist, and it certainly didn't cause them not to apply or to even not to think about applying to that company for a mortgage. But it didn't matter, and I'm not so sure it would matter ultimately, because the question is, is this sufficient that conduct sufficient to establish a violation of ECOA and Reg B? And if you're, as Jay said, if you're the regulator, and your mindset is, I believe it is, they don't care about the empirical data. They're going to just churn until they get what they hopefully want. Same way with the AG in Pennsylvania, they have a specific interpretation of a statute, and it doesn't matter if I showed them that consumers were perfectly happy, they weren't misled, we achieved RESPA compliance as we understood it, and again, no consumer harm. They don't care. They have a narrowed approach to that.
Yeah, the law and the legal system is very inefficient at creating desirable outcomes. But what it can do is create desirable processes, right? And it's really sort of the goal of looking toward, all of the idea of reform is to create processes that are predictable and efficient for the business to work in. And that would be, to me, the goal of most of these reforms. Whether or not that's the way we go, we'll find out. But looking at, some of these things like the Townstone case, looking at the motion that they filed to vacate, some of the data that they threw in there was pretty remarkable. The idea that I think it was something 0.018%, I think is somewhere, it's under 1% of the total amount of time that the defendant was on the air is what led to the case, which is remarkable to think about. Less than 1% of comments that the government based an enforcement action on that. And, that to me is perhaps political, but probably less so. I mean, that was President Trump's first administration brought that. That was under Director Craniger. So, but, looking at the empirical evidence, to me, if you look at that, you'd say we don't have much of a case here with less than 1%.
It's very unfortunate that we lose track of the spirit of the law's purpose, which is, in this case, protecting consumers. And we can no longer look to consumer harm as like a resolution for a situation that's really ambiguous. And that uncertainty just is going to have to add cost to the anyway. I mean, it's really Jason, I think you're right in terms of the law is designed to make great processes and not create great outcomes. But that's a really, really depressing quote that's going to kind of stick in my head for a while. But
it's a perfect segue. I have a breaking news kind of hot topic that will be exactly that, John, which is, James Kleinman from Housing Wire was reporting on Bob Broekschmidt's comments that New Jersey, Trip, where you are sitting right now, has stated that they're considering new heightened disparate impact standards. So, John, exactly to your point of we want a data-driven analysis of what is actually happening in the market, what are the lending patterns, the proposed regulation actually flips the burden of proving disparate impact claim onto the financial institution, or sorry, proving that there wasn't, right? Proving a negative, flips that to the lender. And so Bob's comments from the MBA was, we'll sue. We're planning to sue New Jersey if they follow through with the current definition and the current language of this proposal, because it puts mortgage companies in an impossible spot relative to the data to prove that something didn't happen. And so I just think that's an example of just this week, to Tripp's point earlier, a state stepping out into an area that is historically federal, fair lending, and yet throwing down a gauntlet. Is that the right way to put that? And then Bob stepping up and saying, here's what we have to do. I don't know if you've seen that coverage or if you have any thoughts on it.
Was that the New Jersey is going to somehow think that they're going to reinterpret an existing federal law, or they're going to, I mean, that would be problematic, but if they, and I can understand, the NBA's position on that, but if it's, hey, we're going to create a more stringent regulation or statute ourselves, again, what we're seeing is the states doing it because the federal government's allowing them to do it. Like, they're not leading. If you don't have a leader, you have a mutiny, and so you have a 50-state mutiny, which is like, I'm the leader. I'm the new Napoleon. I'll decide where we march and how we march and what we eat and what we kill or attempt to. And look, I'm not an anti-state rights person at all. Okay. But there's got to be a balance, anyway, so that's not solving any problems. It's just, it's not giving any, qualitative strategies. And I know that, we really should be at least attempting to do that. I think what I would try to do is try to say to states, look, there is a framework that you've consistently worked under. Stay the course, right? You don't need to create new regulations. You don't need to create new interpretations. It's worked. And so let's stick to it. And again, back to Jason's really initial comment, which is, what do we do now? And I think it's stay the course. Wait to see what happens. I know that, like in most industries, and banking is similar, is visibility into the future. Like, think about like TRID. Like, we knew it was coming, and how long we in the industry took to like ramp up. And like, we're ready, we know it's coming. We weren't quite sure what the rule was going to be, but we knew they were. So we wanted to know, we wanted to get ahead of it. We wanted to be the leader of the pack. And I just don't think it's efficient, given, even if you're multi-state, to say, well, I need to be responsive to what I think the state may be doing. For example, like New Jersey. All right, well, you could spend a hell of a lot of money and man hours to get, okay, this is what they're saying that they're going to do. They're going to shift the burden. How do we react to that? I think you stay the course right now.
And I think Bob's right to attack the idea of it, is because, disparate impact has been controversial for a long time. And I think that what it comes down to is that there's sort of a fundamental disconnect in the way that we view what it is. Most people, and I think it sounds like New Jersey is doing this too, view it as an independent theory of liability. What disparate impact really is, though, fundamentally, whether or not states or the federal government want to make it an independent theory of liability, what disparate impact is it's circumstantial evidence of potential disparate treatment. And disparate treatment, 100% against the law. And what you're doing when you're taking evidence of disparate impact is you're looking across your entire data set and you're saying, oh, there are some anomalies here. And these anomalies may have a little pattern. Let me look under and see what's going on here. And that's why when you're doing your fair lending review, you find those anomalies and then you look into them and say, how can these be explained? How can they be explained? Most of the time, I've been through hundreds of these with clients, and I'm sure, Jeremy, you sat through them as well. And you look at them and you get down to it. And a lot of the times it comes down to, a property value issue. It comes down to a credit score issue, something like that, that is easily explainable that you can't see in the broader data set when you get down into it. You can. Now, when you can explain it, that's when you're like, oh, maybe there is some disparate treatment going on here, because that's really what you're looking at. And I think we get back to sort of process versus outcomes here, because the process, looking at it as a process, understands that the evidence of disparate impact is circumstantial evidence of disparate treatment. And what we're trying to stop is disparate treatment, right? Because the legal system is just really inefficient at creating desirable outcomes.
That is a great point. I think that's spot on. And John, one of the themes, Jason, that John and I talk about all the time with TRIPS Stay the Course is actually encouraging state regulators to get closer to the market and closer to the industry to really understand these nuances. Use this opportunity in TRIPS' way of saying it, stay the course. Use this stay the course opportunity to actually understand who are the bad actors, where are the opportunities for bad actors to maneuver or act, and then, like you said, look at the data, look at the circumstances to find out who they are. And I think that it is hard, it is complex. I'm not trying to imply that it's not, but I also think there's a huge opportunity to learn more about how these things work in this moment that actually gets you closer to what really does need enforcement.
Yeah, and not, I don't want to paint, state regulators with a broad brush. It's really where they don't do that. And there are primary examples of that where they don't understand the process, or they don't want to understand the process because they want to fit their notion into a definition, into a word. And so, yeah, I agree with you, Jeremy. I mean, what we should be doing as an industry now, in particular, is engaging with the states, either individually or collectively, to say, before you jump off the cliff here, take us with you. Let's engage and let's talk about it. And so, state MBAs, they should be having their meetings, or even if the individual large players in a state or region, have their meetings now, and don't paint a picture of rubbing our hands together because the CFPB and DOJ aren't going to be doing anything anymore, and sort of saying now we're sort of free to do what we want. But rather, hey, I know that they were the leader. You would follow their lead generally. They're not there. So let's talk about how we can help you understand better, because you were usually a follower, right? And let's see if you can't understand better, this industry and whatever the issues may be. It's not going to work all the time. I can tell you, it's not going to work all the time. And probably doesn't work 50% of the time, but 40% of the time, meaning 40% less spend on trying to react is better than spending it.
Taking a sort of big step back and kind of looking at the picture. I mean, it sounds like a lot of what's happening today is the federal government hasn't taken as much of a step up in leadership in defining some of the rules and regulations for the mortgage industry as maybe it had before, but maybe it had before, maybe too much enforcement through random, right, enforcement types of things, whatever. But then as you kind of as I think about our system, right, we have lawyers. They exist because not all laws are clearly and easily interpreted. But in this case, it's so strange to me, like Congress passes sort of a desired rule. It then sets up another agency to then interpret and make clear those rules. And then states will then further take that and further nuance those rules. And so I guess maybe a two-part question. One is, it sounds like what you're saying is the CFPB needs to come back and clarify these things, not rescind them. Like there needs to be clear guidance. And of course, that guidance can't cover every possible thing, but insofar as it could clarify the outcomes it wants, that'd be the best. But just be clear at the federal level and try to sort of get everyone to follow it. At the expense of that, if you can't, then sort of at the industry level, you got to get really close to the states. So I guess my first question, you're nodding your heads, which our listeners can't see, but it sounds like stronger federal leadership is the right answer. In spite of that, industry stepping up and working with states. Anyway, I guess the second question is what else can the industry do to protect itself from the sort of chaos that this situation creates?
Yeah, I would say it's slightly alter the first statement, which is I would say consistent federal regulation, consistent and predictable federal regulation. Right now, we are being whipsawed back and forth. I mean, you can even think back to when the Bush administration switched over to the Obama administration, the Department of Labor changed its rules on overtime for loan officers, which ended up in the Mortgage Makers Association v. Perez case, right? This is not a new issue fundamentally, but the depth to which federal regulators are stepping back. I mean, they're not even staying in the same place, right? Some people may argue feds should be involved more, some people a little less. Right now, we're taking this huge step back to where now there's going to be a vacuum in a lot of this, which I think is fundamentally detrimental, at least in the short term. Long term, I don't have a crystal ball, unfortunately. I'm pretty bad at predicting the future, but I would think that more consistent and predictable federal involvement is really what everyone wants. Because it's not, again, I don't know anyone really who's out there really saying, you know what, we don't need any regulation at all. We should just be left to our own devices. I think everyone understands that some regulation is generally good for the market. But this sort of overregulation at times to the underregulation, back to overregulation, back to underregulation, creates this massive inconsistency and unpredictability in the market that the people who are trying to predict out, on a 5-year business plan, how do you predict out on a 5-year business plan what the regulatory environment's going to be like under our next administration, whoever it's going to be, when it's changing constantly like this?
Not only is that awful, it's just it adds cost, right? It's going to add legal cost to every
Tons
part
of
of it,
cost, yes.
which is going to hurt companies. It's going to hurt consumers. So the very people you're trying to protect with this sort of over-regulation or under-regulation, it's actually harming when there's chaos. I just think that's an interesting point, that like the result of this goes against the outcome everybody's trying to fight for.
Right. In times like this, and you'll hear lawyers say this all the time about litigation too, when people are really fighting each other hard and not finding any common ground to potentially resolve the matter, is that at the end of the day, in a situation like this, the only people who win are the lawyers.
So I have a different, somewhat more, if not incredibly pessimistic view of what's happening here. I think that there is a calculation being made that stepping back, rescinding and stepping back from enforcement, right, or providing guidance on existing regulations is the plan. It's to create chaos. It's to create uncertainty so that it gets so bad that that everybody, whether you're on the left or the right or in the middle, or you're high income, low income, everyone or a majority of them say, we need something consistent. We need someone, something to step in. We don't care if it's against our interests. We just need consistency, right? And so I would just be very cautious that, again, my view, very cautious about this sort of hurricane, however you want to analyze it, hurricane or tornado, and think about it. A tornado hits and you get wiped out. You don't care who helps you. And you don't even care if the help you're getting isn't consistent with your future goals. You just want something to be consistent. I know I'm going to wake up in the morning and get food. I know I'm going to wake up and my car is going to start. I know the streets are going to be clean. I can get to work. I want that consistency, and I don't care who gives it to me or how I get it or who gets hurt, as long as I get it. And so as an industry, we need to keep that, I think, in the forefront, so that when things are getting bad, as they will continue to get unruly and there's more uncertainty, don't just say, I'll take whatever comes along that's going to provide consistency, right? I mean, again, it's a very political statement. I understand it. That's what it is. But I do think that's important for our industry and all industries that are highly regulated, right? Mortgage or any other consumer financial services, is to keep that could be the possible reason why this is happening. And we shouldn't fall into the trap of just accepting the next thing down the line because it provides us with visibility or transparency or consistency. Is it actually helping the consumer? Is it actually going to help us in the future as a business, as an industry, as opposed to just, again, not to belabor the point, but just an answer at the time where it seems that it will calm the waters?
Well, you said that was pessimistic, but the imagery you gave me, Trip, that's actually I think very helpful to the industry is when the pendulum swings very dramatically, as it did in the global financial crisis, for instance, or the years after, you have these big looping swings. And what Jason was saying, like if we focus on the process, we can limit those swings more and more detailed down to consistency, down to stay the course, as you said. And we're still swinging back and forth, as is sort of normal for markets and normal for the changing of leadership. But we're trying to keep those pendulum swings to a minimum within the protection of the market, the consumer, the industry. And what we're seeing now, what you're saying is it gets pulled way back, and now the swings are going to be more dramatic. Again, that's not actually going to help markets and consumers. And so we've got to get sort of back to that process focus, stay the course. Is that
I'm suggesting that there is no pendulum swing here. It's not like Jason's, his example of when Obama came in and they implemented certain labor and employment rules. That's a pendulum, right? So now we're here. Now we're on, we swung to the left, okay? And we need to operate within that ratio to the left, right? No. This isn't a swing to the right or a swing to the left, right? We're not doing anything.
This is destroying the pendulum altogether.
Altogether. There's not, right. It is destroying. There is no back and forth. There's no we're not to the left or the right, right? We're not now operating in the right swing of the pendulum. We're not operating, as Jason said, there is no pendulum anymore. There is no column in which we are operating. We are operating in a vacuum, right? And again, to my point, don't be ready to take whatever fills that vacuum because it's short term. It causes a calming sensation, or maybe it doesn't calm you down, but it's now consistent. That's my concern, is that
Are you sure, Trip? Because I think the proposal I've been hearing is that you, Trip, will be responsible for interpreting all laws. So you will be the Lord of mortgage. Is that not a good outcome?
If that's the paradigm, given it's me, I'm perfectly fine with it. Everyone else, right? You should accept me.
That's right. You warned me not to. So let me make one quick comment, and then I just want to maybe pivot a little bit to a different kind of question. But if your view is that this regulatory infrastructure, aka pendulum, that we've built is so fucked up because we've spent so many years adding new regulations to old regulations, creating new overseers that oversee other overseers. If your view is that it's so bad, you need to break the pendulum to sort of build something new. And I think what something new is, you can't be desperate for, but it has to be good. I mean, and so the question is, what's that something good that comes and replaces the old pendulum? That may be a little bit more of an optimistic take, but I guess I want to go back to the second part of my earlier question, which is what does the federal government do? Well, what does the industry do? And maybe this is crazy talk, but that's kind of what we're known for. But it's like AI, there's so many really interesting tools. Like if we were to try to say, all right, the industry is going to lead interpretation by using some technology to sort of really start building a rule set of a process set. Like, does that happen in any industries? Is that totally crazy that there could be some industry-led set of rules and regulations that kind of help the industry operate, in this time period where there's no sort of federally enforced ones?
Yeah, I mean, I don't think it's crazy at all to think that, the industry can sort of lead on some things, but obviously you have to be careful to not lead in a direction that's going to be in conflict with what still exists. At the end of the day, destroying the pendulum or burning it down may or may not happen, but right now there are things that still exist, right? So leading in the right direction is important. Many other industries have standards that they implement that are over and above, that aren't the law necessarily, that start out as, voluntary industry standards that then become best practices, and then at the end of the day, might be adopted by a regulator. And in a situation where perhaps everything gets burned down and you're looking at the fertile ground there and what's going to grow next, having a solid and strong set of industry standards for whoever comes next to look at, it's not a bad thing.
Yeah, I totally agree that if the industry could establish and basically regulate itself, and you could hopefully get a majority buy-in. I don't know what a majority is, a 90%, a strong buy-in to whatever those guide rails are and so forth. I mean, you can look at, just for that very, very unique concept, you could look at Alta, right? I mean, it has forms, it has best practices, and most title agencies and underwriters try to follow that, right? And they feel like if they're following it, they're doing best practices and they're using the right forms and they're reporting it. If they're an agency, they're reporting correctly to their underwriter about what they should be doing. Reconciliation on title, all of those things, none of that is directly regulated by the states. Okay. States regulate licensing. There are certainly certain market conduct studies that are done, but again, the statutes are and regulations pretty clear what they're going to be looking at. That would be great. What would happen if an industry member violated that? Now, can it be industry enforcement? Now, we don't have in this industry like we have in the bar associations where you could get disbarred. The state bar association could bring a complaint. They could bring that in the state court, and a lawyer could lose their license based upon something. We don't have that in this industry, and I doubt that we would ever have it. But so that's sort of a pipe dream in terms of like actually industry enforcement outside of state and federal cooperation. But it would be good. I mean, it lead. And then I would say the next thing is, if you create those, whether it's LO comp, whether it's servicing, whatever those operations happen within, the industry in general or a subset of the industry, then ask the state and federal, can we do it in a sandbox? Can we do it so that, for the next year without facing potential or facing the real potential of an enforcement action or an investigation? We'll have complete transparency with you. You'll be in the sandbox with us. We'll be sharing our toys. We will be building a better sandcastle with your participation. That would be really good. But again, you need to have participation by the state at some level of that sandbox.
And we need people at the state or the feds who don't have the same view as Rohit Chopra had on it and just believe that they exist. The industry wants them to exist so they can take advantage of them. We need to have the stakeholders coming to this in good faith.
Yeah, and not a view that lawyers are just doing this to get paid. That's the only reason that we're taking these positions, is because we don't care what happens to the consumer or the industry. It's just our ability to get more money in the door.
Makes me think of and this is going to date me, the old Tony Blair quote. Somebody asked him why he was supporting George Bush in the invasion of Iraq, and made some derogatory comment about why he would do it. He said, "Oh, it's so much worse than that. I actually believe in it."
Well, I think that's a good example of why we wanted to do this podcast, because of the complexity of these challenges, and knowing what you said at the outset, Jason, which is you got to run a business and it has to work. And most of the time, in my experience, all of the time, the people who are trying to do it the right way, who are trying to find those best practices and implement them, who are working with their attorneys, both in-house and outside counsel, to do it, the ones interacting with the state are the ones trying to get it right. The bad actors aren't going to the best practices, the state, the association, and trying to figure it out. So if you're there in the room
trying to fly under the radar,
yeah, they're trying to hide. So the people who are raising their hand and saying, help me figure this out, are almost always, and again, in my experience, always the ones saying, we can do this. We can do it better. We believe in it, to your point. So I think that's why, I really got a lot out of this conversation and thought it's valuable to share. So I appreciate your perspective.
that probably does it for this conversation. I wish we could go on longer because there's so many different issues and topics that need to sort of be untangled. But I think the sort of top level advice for the industry and others has been really helpful. And Tripp and Jason, obviously you guys experts. Saul Ewing, super helpful organization. So for those who are struggling to figure out what to do or facing litigation, obviously you guys know who to call. These guys are amazing. So anyway, that does it for the episode. Thank you guys so much. Really appreciate you guys joining us.
Well, thank you for having us on.
Absolutely. And so to our listeners, we'd love to hear from you. Please send us an email at podcast@thehousinginsiders.com. If you like what you hear, you like this episode, don't like the episode, why don't you just leave us a review and leave some comments?
That's right. We want to know. And if you could share it, you could subscribe. What that does for us is it lets us create more of these episodes and get more of these issues out there. So please subscribe and share. And thank you again for listening. And thank you to Keenan Chen for our music.